Welcome to the Deep Dive. We're here to cut through the noise and give you the core insights you need. Today we're doing a full-on plunge into something pretty significant happening in the market. The upcoming IPO for HDB Financial Services Limited. And this isn't just, another stock offering. It feels like a really unique chance to understand a major player in, one of the fastest growing economies globally.
That's exactly right. So our mission today, basically, is to pull out the absolute must-know insights from HDB Financial's own red herring prospectus. We'll look at their business, dissect the financials, check out their market position, flag the key risks, and, importantly, explore their growth prospects. The whole idea is to help you get a really solid grasp of the essentials quickly without getting totally bogged down in, hundreds of pages of detail.
Okay, great. Let's unpack this then. For anyone maybe not super familiar, who exactly is HDB Financial Services Limited? What's their main deal in the Indian financial scene?
Okay, so at its heart, HDB Financial is currently the 7th largest NBFC in India.
NBFC?
Yeah, non-banking financial company. And they're focused on diversified retail lending. That ranking, by the way, is based on their total loan book as of March 31st, 2024. Also really important, the RBI, the Reserve Bank of India, classifies them as an upper layer NBFC.
Upper layer. What does that signify, practically speaking?
Well, it means they're under much tighter regulatory watch, almost like a big bank. So yes, more compliance hurdles, but it's also a signal, a strong one, of their importance to the system, their stability. And here's probably the most foundational point. They are a subsidiary of HDFC Bank Limited.
India's largest private bank.
Exactly. That connection, that parentage gives them a huge strategic leg up. Think brand trust, access to funding.
Yeah.
It's significant.
Yeah, that HDFC connection definitely sounds like a core part of their identity. So, okay, their business, what kind of lending are we actually talking about? You said diverse.
Oh, definitely diverse. They operate across 3 main business verticals. First up is enterprise lending. This is basically loans for micro, small, and medium enterprises, MSMEs, covering all sorts of business needs. These loans can be secured, backed by collateral like property, or they can be unsecured. Just to give you an idea, their enterprise business loans, the ones secured by property, have an average size of about 1.17 million rupees and typically an 8-year term. So focused on longer-term business growth.
Right, supporting businesses. And beyond that, they're also big in asset finance, I understand. What sorts of assets?
Precisely. Asset finance is key. They finance things like new and used commercial vehicles, heavy construction equipment, even tractors for agriculture. Think about construction equipment loans. Average size is around 2 million rupees, typically a 3-year term. And what's interesting is that based on the prospectus, about 78% of those loans are for new equipment.
Oh, interesting. So that suggests businesses are investing, modernizing.
Exactly. It points to demand expansion, especially in infrastructure and logistics.
Got it. And then for just, regular people, there's the consumer finance side too?
Absolutely. That's the third pillar. It covers a really wide range of personal needs. We're talking personal loans, loans for consumer durables, fridges, TVs, that stuff, two-wheeler loans, which are huge in India, and even microfinance loans.
Microfinance?
Yeah.
So reaching those who might not have access to banks.
Exactly. Targeting underserved segments. It's a really broad reach, tapping into different consumer needs.
Okay, so a diverse portfolio is one thing, but India is massive. How do they actually reach all these different customers everywhere? I heard something about a phygital model. Sounds catchy.
Yeah, phygital, it's core to their strategy. It's this blend, right? Physical and digital. They have a huge physical network, 1,771 branches across nearly 1,200 towns and cities, pan-India. But here's the kicker. Over 80% of those branches, they're outside India's top 20 largest cities.
Wow, so really going into smaller towns, rural areas?
Absolutely. It's strategic, targeting underbanked populations where, frankly, traditional banks often don't have a strong presence. Huge potential there. And at the same time, they lean heavily on tech, sophisticated, data-driven credit underwriting. As of March 2025, over 95% of their loans were underwritten digitally, end-to-end.
So wide reach physically, but super efficient digitally. That makes sense.
It allows for both scale and efficiency.
And I also saw they used to do some BPO work for HDFC Bank, but that seems to have dropped off quite a bit, like from over 20% of income down to under 7.5% recently.
Yeah, that's a noticeable shift.
Feels like they're really sharpening their focus back onto the core lending business, wouldn't you say?
I think that's a fair assessment. It definitely suggests a strategic reprioritization, probably doubling down on what they see as the main growth engine, the financial services side.
Okay, so we have a good picture of what they do and how they reach people. Now, the part everyone wants to know about, The numbers. How's the financial engine looking? How's HDB Financial actually been performing?
Well, the financial story is largely one of significant expansion. Let's look at their total gross loans. They grew to 1,068.8 billion rupees by March 31st, 2025. That's a compound annual growth rate, CAGR, of about 23.5% between March 2023 and March 2025. Pretty robust growth.
Okay, 23.5% CAGR on loans, that's strong. What about income?
Their net total income from lending also saw healthy growth. It climbed with a CAGR of nearly 17.87% to be precise from fiscal 2023 to fiscal 2025, reaching about 87 billion rupees. So strong top-line figures definitely suggest they're capturing market share.
Impressive growth, yeah. But I was digging into the profit after tax, the PAT, and I saw something a bit, well, surprising. While the overall trend from fiscal 23 to 25 shows growth about 5.4% CAGR, the PATs actually dropped year over year in fiscal 2025 by over 11.5%. That seems counterintuitive with loans and income growing. What's going on there? Should that be a worry?
That's a really sharp observation, and it's definitely a point worth discussing. You're right, that year-over-year dip in fiscal 25 stands out against the broader positive trend. Now, a profit dip like that could be driven by a few things. Maybe higher operating costs from expansion, maybe increased provisions set aside for potential bad loans, or perhaps the cost of borrowing went up in that period. The prospectus doesn't spell out the exact single reason for that specific year's dip, but it's important to see it in context, right? Their loan book was still growing strongly. It's certainly something potential investors should keep an eye on. Was it a blip or is it the start of something? But based on the overall picture, it might just be a one-off related to investment or market conditions that year.
Okay, fair enough. Context is key. So putting that specific dip aside for a moment, how do their main profitability and efficiency metrics look overall?
Generally, they look quite solid. Their return on assets, ROA, was 2.16% for fiscal 2025.
How did that stack up?
Well, it puts them seventh highest among their NBFC peers. So decent operational efficiency in turning assets into profit suggests a healthy core, though maybe still room to improve relative to the absolute top performers. Their return on average equity, ROE, was 14.72% in fiscal 2025. That ranks them fifth highest among peers, indicating a pretty good return for shareholders.
Okay.
And their cost-to-income ratio, it's remained relatively stable, around 42.8% in fiscal 2025. This suggests they're keeping a decent handle on their expenses relative to the income they're generating. Good operational control.
Right. And what about the quality of those assets they're building up so quickly and their capital strength?
Yeah.
Always crucial for lenders.
Absolutely critical. So asset quality first. Their gross non-performing assets, or GNPA percentage, stood at 2.26% as of March 31st, 2025.
2.26% is a good, bad average.
It's a key metric showing loans going bad. Lower is generally better. 2.26% is, well, it's a manageable level in the context of their portfolio mix, which includes unsecured lending. Then capital strength. Their capital adequacy ratio, CRAR, was 19.22% on the same date.
And the minimum requirement is?
15% from the RBI. So they're comfortably above that minimum. It shows a good buffer against potential losses, keeps them compliant. Their debt-to-equity ratio was 5.85 as of March 31st, 2025, which shows they are using leverage pretty actively to fund that growth we talked about. And another interesting point, their average cost of borrowings was 7.90% in fiscal 2025. That's actually the sixth lowest among their competitors.
Lower cost of borrowing, that's a big advantage. Why is that?
It's significantly helped by their strong credit ratings. They've got AAA ratings from both CARE and CRISIL with a stable outlook. That HDFC parentage likely helps here too. It means they can borrow money more cheaply than many rivals.
Got it. I also saw a note about negative cash flows from operations, investing, and financing back in fiscal 2023. That sounds potentially worrying.
It can sound that way, but you have to interpret it carefully for a company in growth mode. Often, for a rapidly expanding company like HDB, negative cash flow across the board, especially in investing, signals a period of heavy, deliberate investment. Think building out that huge branch network, upgrading technology platforms. These things cost a lot up front. It's not necessarily a sign of weakness, more likely reflects deploying capital to build the foundation for future earnings.
Okay, that makes sense. So we've got the business model, the financials. Let's zoom out. What's the bigger market opportunity here? What kind of environment are they operating in that could fuel this growth going forward?
Right, the macro picture. And honestly, HDB Financial seems really well placed here. India's economy is projected by the IMF and others to grow strongly, significantly outpacing many global peers. And the drivers are powerful structural things. India has this massive young population. Urbanization is increasing rapidly. All these factors just create enormous demand for financial services, loans, insurance, you name it.
And are there specific segments within that big picture where HDB seems particularly well positioned to win?
Definitely. The MSME sector is a huge one. There's this well-documented, massive credit gap. One estimate put the addressable demand at something like 36.7 trillion rupees back in fiscal 2017. It's a vast, underserved market for formal credit.
And HDB focuses on MSMEs, so that's a direct opportunity.
Exactly. Then there are the underpenetrated rural and semi-urban areas. We talked about their branch network. Consider this. Rural India contributes almost half the country's GDP, but as of March 2025, it received only about 9% of total banking credit. That disparity is enormous. It's a huge market that NBFCs like HDB, with their specific focus and reach, can tap into effectively.
Right.
And finally, don't forget government initiatives, things like the Jan Trinity Yontan, Aadhaar, mobile direct benefit transfers, eKYC using Aadhaar, priority sector lending rules. All these are pushing financial inclusion, formalizing the economy, and basically creating customers in demand for the kind of services HDB offers.
So multiple tailwinds pushing them forward.
Yeah, and the prospectus itself has some pretty bullish projections for their core segments based on external reports, like unsecured business loans, projected to grow at an 18-20% CAGR through fiscal 2028. Microfinance, where NBFCs are already dominant, expected 8-10% CAGR over the next few years. Commercial vehicle finance, personal loans, continued growth expected there too, helped by better tech and underwriting.
Yeah.
It paints a pretty optimistic picture for the market opportunity.
Okay, makes sense. But no company exists in a bubble, right? It's a competitive space.
Yeah.
Who are they up against, and how do they actually compete? What's their edge?
It's definitely a dynamic and crowded field. They compete head-on with other big NBFCs, think Bajaj Finance, Shriram Finance, plus, of course, traditional banks. And increasingly, you have the fintech players jumping in, often very agile, very tech-focused.
So how does HDB stand out in that mix?
They compete on a few fronts. The breadth of their product range, their ability to customize, speed of service, that's often where NBFCs can beat banks, and, crucially, brand recognition. That HDFC name carries a lot of weight. Specific advantages. Well, NBFCs generally, including HDB, have carved out a strong niche in MSME lending with faster turnaround times. And interestingly, the prospectus notes that HDB Financial actually has lower gross NPAs in consumer durable loans compared to private banks. That suggests better risk management in that specific competitive segment.
Okay, competitive advantage is noted. But every investment carries risk. Let's talk about the potential downsides. What are the key risks highlighted in the prospectus that someone looking at this IPO really needs to be aware of?
This is absolutely critical, and the prospectus is quite clear about several significant risks. Let's break them down. First, financial risks. There's always the potential for asset-liability mismatches down the road. Imagine funding long-term loans with short-term borrowings. If funding markets tighten, that could cause liquidity issues.
Right, managing that timing difference.
Exactly. They also rely heavily on wholesale borrowing. So being able to consistently secure funding at good rates is absolutely essential for their growth. If that access tightens, it hits them directly. Interest rate volatility is another one. If rates rise sharply, their borrowing costs could go up faster than they can reprice their loans, squeezing their net interest income.
Makes sense.
And then customer defaults, especially on unsecured loans, which are riskier by nature. Even for secured loans, which are the majority, around 73% as of March 2025, actually recovering the value from collateral if a borrower defaults can be challenging and time-consuming.
Okay, those are the financial ones. What about operational or regulatory risks?
Yeah, plenty there too. Operational and regulatory risks. Cybersecurity is a big one. Hacking, phishing attempts, Trojans. A breach could mean data loss, reputational damage. It's a constant threat for any financial institution. The prospectus even mentions specific instances of detected fraud, 5 cases in fiscal 2025, 6 in prior years. Includes an example where employees at one branch fraudulently process loans. Shows internal controls need constant vigilance. Wow, okay.
Another big operational challenge mentioned is employee attrition. The rate for permanent employees in their lending business was really high, over 50% in fiscal 2025.
50%. That's huge. Must make recruitment and retention incredibly tough.
Extremely tough. Finding and keeping skilled people is vital, especially when you're growing fast. That's a significant headwind. Then there's the regulatory landscape. They have to constantly adapt to changing rules from the RBI, SEBI for the IPO, even IRDAI for insurance distribution. Compliance is complex and costly. They're also involved in various legal cases, tax, criminal, regulatory against the company, HDFC Bank as the promoter, and directors. An unfavorable outcome in any of these could have an impact. And finally, that dependence on HDFC Bank. While it's a huge strength for brand and support, it also means potential conflicts of interest, since HDFC Bank itself offers many similar products. It's a bit of a balancing act.
Okay, that's a comprehensive look at the risks. So, pulling it all together, the business, the financials, the opportunity, the competition, the risks. What's the overall outlook? How does this IPO position them for the future? Well, looking at valuation metrics briefly mentioned in the prospectus for fiscal 2025, the basic earnings per share, EPS, was around 27.40. The net asset value, NAV, per share was about 198.8 as of March 31st, 2025. These give a baseline. Now, the IPO itself, the money raised, the net proceeds, are specifically targeted for one main thing: boosting their Tier I capital base.
Strengthening their core capital.
Exactly. This is absolutely fundamental. It fuels their ability to lend more across all their businesses: enterprise, asset finance, consumer finance. It's the fuel for future growth, and it's also crucial for staying compliant with capital adequacy regulations as they scale up.
So the IPO cash basically goes straight into the lending engine. Makes sense. Beyond that capital boost, what are their bigger strategies for growth?
They outline a few key strategies. One is product innovation. They plan to keep broadening their product range, making it wider, and critically, use their large existing customer base for more cross-selling and upselling. Get more value from each customer relationship.
Leverage the base they already have. Smart.
Second is technology integration. They're signaling continued heavy investment here. Data analytics, machine learning, even generative AI. The aim is to improve customer experience, make underwriting even sharper to manage risk, make collections more efficient, and just boost overall employee productivity through tech.
Right, efficiency gains through tech.
And third, talent management. They explicitly talk about focusing on attracting, training, and crucially retaining talented staff. Given that high attrition number we discussed, this is vital for sustainable growth. They do note the stability of their senior management team, which is a plus.
Addressing that attrition challenge head on.
It seems so. And underlying all this, again, is that HDFC Bank parentage. The brand, the access to relatively cheap funding thanks to those AAA ratings, the strategic support. These are powerful enablers expected to help them keep growing despite the challenges.
Okay, so this deep dive into HDB Financial Services Limited, it really paints a picture of a company with a lot going for it, but also some clear hurdles. You've got this major player status in a booming Indian market, the backing of a financial giant like HDFC Bank, a diverse loan book, and that clever visual strategy reaching deep into underserved areas. The growth numbers look strong. But on the other hand, there are those risks we laid out: managing employee churn, cybersecurity, potential bumps in asset quality, interest rate sensitivity, and just navigating that complex regulatory work.
Precisely. It's a compelling mix. And that leads us to the final thought for you to consider. Given HDB Financial's solid foundation being part of the HDFC family, and combining that with this aggressive digital push and focus on India's vast underpenetrated markets, what does that unique blend of, say, stability and agility really mean for their long-term path? And maybe more pointedly, how effectively can they navigate those headwinds we talked about, like the high attrition or potential shifts in regulation, to keep that growth story alive and thriving in India's incredibly dynamic financial landscape?